Thank you for joining us at XM.com for today's Daily Market Comment by Mario Sajikiriakos. I'm Christina Marujos. A bombshell inflation report from the United States sent a wave of relief across global markets yesterday, sending the dollar into a tailspin and igniting a stunning rally in risky assets amid bets that the Fed is about to dial down its rate increases. Inflation, as measured by the CPI, clocked in at 7.7% on a yearly basis, much cooler than the anticipated 8%, fueling hopes that the worst of the cost of living crisis is behind us. This data set cemented the notion that the Fed will raise rates only by half a percentage point next month and push the terminal rate back below 5%. While investors interpreted this as a major victory, the inflation war is not won yet, and wagers that the end of the tightening cycle is imminent seem premature. Hopes that inflation is finally moving in the right direction gave market participants the green light to load up on riskier assets, sparking an epic buy everything rally. Stock markets went through the roof, with the Nasdaq gaining an astonishing 7.5% in one of its best days ever, as yields on government bonds came crashing down. The only loser was the US dollar, which suffered sharp losses across the board. Long dollar was probably the most crowded trade in the entire market, so the prospect of the Fed shifting into lower gear set in motion a mighty round of profit-taking. Gold prices rose almost 3% and continue to build on those gains today. A sharp decline in the dollar and real US yields served as rocket fuel for bullion, making it more attractive as borrowing costs decline. Admittedly, this seems like an overreaction. The Fed story hasn't changed enough to warrant such dramatic moves in every asset under the sun. Stock market rallies exceeding 7% are usually not a healthy sign, and in fact generally occur within bear markets. Positioning most likely played a huge role in enabling these moves, with short positions in equities getting smoked and long dollar bets getting liquidated. Capitalizing the most on the US dollar's troubles was the Japanese yen, which gained nearly 4% in a single session as interest rate differentials compressed to its benefit. A case can be made that the yen is setting up for a trend reversal, as the Bank of Japan chief opened the door for adjusting yield curve control last week. Of course, the timing of any Bank of Japan shift will depend on wage and inflation dynamics, and any real comeback in the yen might be a story for next year. Still, the narrative seems to be shifting. Thank you for watching the Daily Market Comment at XM.com. Have a great weekend.